Welcome back everyone, and in this video, we're going to go over the two new risky stocks I just bought for my high growth portfolio. So I created this separate portfolio to invest directly into SPACs and small cap companies that have the potential to exponentially grow over the next few years. These are the companies that do have a lot of associated risk because they're very early on in their developmental stage. But these are also the companies that do have a ton of potential to grow at a massive rate, and these are the stocks that may see that 5x or 10x return in only a few years. So a lot more risk than my traditional blue chip dividend paying companies that you see in almost every video, but also the potential to see some exponential reward over a shorter period of time. And I created this portfolio just about a month ago, and so far we're up close to 10% at this current level. So you can see right now, all the companies you see on screen are stocks that I've already shown you from this portfolio. I own companies like Neo, Tattooed Chef, Virgin Galactic, and a few other SPACs that may have the potential for some exponential growth after their mergers. And you can see as a whole, we've been doing pretty good so far. A lot of SPACs have taken off, and you can see that for a couple of my holdings, I'm already up more than 30% on a 1 month span. So what I'm doing with this portfolio is just invest in these smaller cap companies, very small positions, just to really track them over the long term to see which companies can succeed and which ones really can't. I'm not going to allocate a ton of capital to each company. I'm going to have a little bit more diversified list only because it gives us more variety and will allow us to follow more companies over 2021 and beyond. And now we're going to jump in to the two new additions I made to this portfolio over the past few weeks. And the first company I bought was ticker OPEN, Open Door Technologies. So this company hit the public market in late 2020 via a SPAC merger. And what they're planning to do is to disrupt the traditional real estate market that hasn't really changed in decades. They're giving you a better platform to sell your house faster and quicker with less fees than ever before. And the company has been accelerating at a massive rate. And via their SPAC merger, they have some nice billionaire investors that I really like personally. Chamath Palihapitiya believes this is his next 10x idea, and he was partnered with Open Door Technologies to take the company public during their SPAC merger. So how the Open Door platform works is that if a homeowner is looking to sell their house, they can request a quote from Open Door. Their platform and their algorithm will put together a price and offer it to the homeowner. If the homeowner chooses to accept that purchase price, Open Door actually directly purchases the home from that homeowner. They take ownership of the house, they renovate, they fix it up, and then they sell it later for a higher price. And right now they operate in 21 different markets within the United States. So Open Door generates revenue from the increased price that they sell the home at, plus they also do collect a small fee during the transaction process. But of course the fee they collect is much lower than the traditional way of selling your home through a normal real estate agent and the decade-old process. So as a whole, Open Door has been growing at a massive rate, and I do see the potential that they can be a huge market leader in the undisrupted real estate space. So now we're going to jump into their investor presentation, and I'm going to share with you some reasons why I purchased this business. So overall, their revenue growth has been exponential and has actually accelerated as of late. In 2017, they generated less than $1 billion of top line revenue, up to $1.8 billion in 2018, and they closed out 2019 with $4.7 billion of total revenue. And the amount of homes they sell each and every year has been growing at a massive rate. And by year end 2019, they sold more than 18,000 homes. And overall, the real estate market is highly undisrupted. Not many companies are changing the way we traditionally sell our homes. And I think Open Door can be a major player and can actually get a significant part of this $1.6 trillion per year real estate market. And the design of Open Door's platform is set up to make the process of selling your home simpler, safer, and faster than ever before. So right now on the screen is the traditional way of selling your home. You decide to move, you have to go through all these different steps in order to actually get your house sold. And these total steps in this process can lead to 12% more of your transaction going to various fees and commissions. And for an average home, that could lead to up to $30,000 of fees going out of your own pocket. But overall, the Open Door platform is set up to be simpler, safer, and faster than the traditional process that we have been doing for decades. You can see it's simple, it's certain, they give you a direct price, it's fast and flexible, and you can actually close in as fast as 3 days, and it is completely safe. And you can see there are actually reduced fees than the traditional real estate route, giving your net proceeds to the homeowner a higher value than ever before. So overall, Opendoor is changing the way we are selling your house. And as a platform as a whole, once they expand into new markets, I think this will really be a go-to way of selling a home. And this company is still very early on in their growth stage, and I think they will be able to expand at an accelerated rate over the next 3 to 5 years. Their first 6 markets for the company have a revenue run rate of $2.7 billion, and that's only for 6 markets. Today, they currently operate in 21 markets, and their market run rate is at over $5 billion. And what I like for the future is that their current playbook takes them to $50 billion in revenue with 4% market share of 100 main markets across the United States. That's absolutely incredible, and that's not even everywhere. Those are really only the main cities within each state. They still have a ton more room to expand out greater than the main hubs from each state that they operate within. And as a whole, the entire US market potential is 1.3 trillion. I don't think they'll ever hit that point, but if they do get a small percent of this massive market, this will still be a huge company with massive annual revenue streams. So as a whole, the company's done a great job, and they're still very early on in the digital transformation of real estate. Like we've seen over the past few years, retail, transportation, used auto sales are all getting disrupted by a new tech market leader. Companies like Amazon, Uber, and Carvana are changing the way we shop, we get around, and we buy used cars. And now for the real estate market, Opendoor is going to be the disruptor of this $1.6 trillion per year industry. And of course, they've only gotten less than 1% digital sales at this current level. But as time goes on, even a small chunk of the massive real estate market of the United States can mean Opendoor can be a massive success with tons of annual revenue and income each year. So I see the potential. I really do believe this is a great way to operate, and I think the Opendoor platform is solid. I like how the business is set up, and I really do think that investors backing the company, like Chamit Palihapitiya, are really good names that I think are going to take the company to a new level. So Opendoor Technologies was the first of 2 high-risk, high-reward stocks I bought to start out 2021. This portfolio is going to be based on buying disruptors to traditional way of life, and of course we know Opendoor Technologies is changing the way we buy and sell homes. And the second company I bought for this portfolio was SKLZ, ticker SKLZ, and this is a new company that is involved with esports and esports gaming. And I think that industry as a whole has still not even come close to the full market potential. With the stay-at-home orders and the lockdowns, that has only accelerated the growth of esports, and I think that trend is going to continue over the next decade. Right now, esports are actually growing at a faster rate than traditional sports, and the revenue of these companies are only growing at an exponential rate as well. And I like the way SKLZ is positioned to allow one-on-one competition for different games across mobile platforms. So essentially what they do is they provide different tournaments. You can enter a tournament to win cash prizes from various different mobile applications. They are not in the traditional console space, and I'm happy about that because that type of market is already very saturated with some main players like the Microsofts, the Sonys, and the Nintendos. This company is different. They operate within the mobile gaming space. They host millions of tournaments each and every year, and they see a ton of gamers and developing entering into their platform each and every day. The company currently trades at just over $21 per share and has seen some accelerated growth after their SPAC merger, and shares are up more than 95%. And we got some big news over the past week that ARK Invest actually purchased some shares into SKLZ Esports. So this is a good news for the company. It shows that they are a disruptive innovation because that's what ARK solely focuses on. The company purchased only 215,000 shares of this business, which for a company like ARK, who manages tens of billions of dollars, is only a small investment. So as a whole, we know SKLZ is a mobile gaming platform that allows different players to connect through competition and tournaments and allows you to actually win some small cash prizes. And if we take a look at their business model, essentially how it works is that the gamers pay to enter in a tournament or play a one-on-one game. That total fee is broken up, and the total revenue right now is a 14% take of the combined fee of the players. So right now, SKLZ, the esports company, will take 16 cents of the $1.20 gain. They have around 95% gross margin, and then of course they have some operating expenses, and their total contribution is around 25%, or 4 cents for every $1.20 entry fee. So I understand just looking at these numbers, You may think that there's not enough money to be made, but these games are happening in volumes of millions games per day, per week, or per month. So there's a ton of different people playing these games with these 60-cent entry fees or above. That's only a smaller fee that continue to play every single day. And if we take a look, the average user on Skills spends more time per day playing on their platform than the average person does on TikTok, Facebook, YouTube, Candy Crush, Snapchat, and the average mobile gaming is only 17 minutes. But you can see Skills users spend 62 or over 1 hour per day on their platform. So they are the fastest and have a ton of user retention rate compared to many other traditional platforms. And that's absolutely incredible. They generate 70% more engagement than the number one mobile game. And that's incredible. And what they've done is created a platform that rewards both the developers and the gamers. So if we take a look at the Skills cycle, you can see that as more gamers come to the platform, there's more engagement and more revenue going to the developers. And as there's more revenue and more engagement with their platforms, developers are going to continue to update, create more games, and that's going to provide more content and more engagement for the gamers on the platform and makes the overall Skills network more attractive to new gamers because developers continue to push out better than ever games. So this cycle only works in unison, and as it continues to accelerate, there's a snowball effect where there's more developers creating better games for more gamers to join the platform, spend more money, win more money, and the cycle continues to grow at a massive rate, and Skills is directly in the center, collecting their revenue each and every day. So as a whole, Skills has been growing at a terrific rate. Their 2019 to 2020 expected growth rate is 88%. Their payback period is 4 months, and their estimated revenue for 2020 is $225 million. And if we take a look now at their financial summary over the past few years, you can see their take rate, they're actually expanding in the future to 15%. So that means for every game, they're going to take 1% more and generate more revenue as more users actually enter the platform. You can see as time goes on, there's more money coming to the business, and each and every year, they're expected to hit record highs. Revenue, this is in millions. You can see in 2017 was only $17 million, up to $51 million in 2018, 2019, $120 million, 2020 year expected is $225 million, and that's only to accelerate. And by 2022, we're expecting this business to bring in over $500 million of annual revenue. Their gross profit margin is extremely high, and you can see their contribution or somewhat of their bottom line will be very high over the next 2 to 3 years down the road. So as a whole, the company is expected to continue to accelerate as time goes on, and we can see the momentum is not slowing them down. And another very important factor of their business that allowed me to actually make this investment and make me feel comfortable buying into this very young company was their balance sheet. For those of you who are subscribed and have been following the channel for a long period of time, you know I'm a balance sheet lover. I really do value companies with a strong balance sheet. It really makes me feel confident buying in because if the company's in a strong financial position, they will continue to operate for a long period of time and continue to grow revenue and provide investors with a ton of value. So if we take a look at Skills' balance sheet, for a lot of young companies, one problem they have is they associate a ton of debt to the business very early on to grow. And that's what really leads to the eventual downfall of a lot of small companies. It's the debt level. People will say everything they want about why a company fails, but in reality, if a company can manage their debt, it's affordable, they are able to pay it off on time and still have a ton of excess cash to grow the business, then it's really hard for them to go under. Even if revenue doesn't accelerate year over year at a massive rate, if the company can keep the doors open, keep fighting to grow, then eventually it could work out. So companies were very young on to take on a lot of debt, it's really a big turnoff for me. But Skills hasn't done that. If we take a look at their latest report, that is only September 30, 2020, so it is about 3 to 4 months old, you can see their total cash and short-term assets come in at over $66 million. And their total assets come in at over $86 million on the balance sheet. And if we compare that to their total liability of this business, you can see right now they have no long-term debt. They paid off all their long-term debt over the past 12 months, which for me is a huge sign. I love seeing the zero on the balance sheet. Their total current liabilities come in at over $40 million, but if we compare that to their total current assets of over $66 million, I'm not worried about these current liabilities. And you can see a large part of them are accrued professional fees. This is because of the merger and them going public. So once they pay these off, these are not recurring fees. Once those are done, they're done. And then, of course, their current liabilities are going to be much lower than where they are today. And why I like this business, of course, is this over $66 million of total current assets can deal with these total current liabilities very well in the next 12 months. And then the company will be able to operate in 2022 and beyond with very little debt on the balance sheet. So I'm a big fan of the balance sheet, and I do think the company will be able to grow over the next few years. And of course, why I value the balance sheet so much when evaluating companies for this smaller high-risk portfolio is because if we take a look at any company on this list or any other SPAC on the market, if we go over their investor presentation, of course it's going to be very optimistic. No company's going to come out with a report very early on in their development and say, we only have a small addressable market, we're projecting very slow growth, we don't think the company's going to accelerate, we're projecting 3 to 5% annual growth over the long term. No one would buy in. No one wants to buy into a small company with a ton of risk when they're only expected 3 to 5 per year growth, because you can buy any of my blue chip companies and get a better rate of return than that of a more risky play. So why I value the balance sheet so much is because these investor presentations, they're all set up on estimates. We're not for sure if they're going to hit these expectations for revenue down the road. We don't know what's going to happen. But what we do know right now is the current balance sheet and the current financial position of the company. And if that's strong, it gives them a better chance of actually hitting these numbers for many years down the road. So Open Door and Skills were the two companies I added to this high risk portfolio. Very small positions, nothing significant, of course, compared to my main portfolio that sits at a value at just over 80,000. But this is a fun experiment. We follow this portfolio every couple of weeks just to track the performance to see how it's going to grow over the long term. And close to 10% gain in only a matter of a month to start this portfolio, I believe is very strong. So if you like this portfolio, you like this new platform, please hit the like button and subscribe. I'm the Gen Z Investor. We talk about the stock market every single day. So please hit that like button, subscribe for daily videos, and see you in tomorrow's video.